Good afternoon. It is time for today's tax talk. I'm your host. I'm attorney Stephen Leahy. It is Tuesday, January 11th, the year of our Lord 2022. And as we reported yesterday, the IRS has set the dates. Today's Crypto Tuesday, so we're going to talk about cryptocurrency and other blockchain assets. How are they taxed? That's what we're going to talk about today. Ed, won't you join us? Thank you so much for joining us. It is Crypto Tuesday. I'm not going to forget today. I'm going to ask you to like and share our content. Remember, tax news is really the core of all news. Almost all news is really based on, except for the violent stuff, right? Although tax stuff can be violent in its own way. But except for, tax is really at the core of all news. How are they going to tax you? Who are they going to tax? Who's going to get the benefits of that tax? All of that is coming up on the tax issue. And so because it's the core of really news, tax news is essential. And I don't know if there's another outfit out there that is presenting you tax news each and every day, Monday through Thursday. Because remember, Friday we do the other podcast, the Watch Talk Radio podcast. But we present this Monday through Thursday in the evening, the up-to-date tax news. And so I'm going to ask you to like and share our content. We can't do it without you, so we're going to ask you to do that. So thanks so much. If you're here watching, please do that. So in the meantime, let's talk about the issues of the day. Today, we're going to talk about cryptocurrency and blockchain asset taxing. Again, great. I think these are great issues. But as is our want, we're going to begin by talking about the value. So we always go to coinflip.tech, our favorite site, and talk about crypto markets. This is the crypto market in the last 24 hours. You can see it took a big dive, rebounded. All of them did. Bitcoin, Ethereum, Litecoin, they all took the big dive today, but then they rebounded and got even higher than they began the day. So they're all plus today. Let's look at for the last week where they were from the last time we were here together, and you see that Bitcoin really did take a big hit over the week. Only modestly rebounded in the last couple of days, actually today, and so again the roller coaster is upon us. So let's look at Ethereum and see if we can. Here's Ethereum, similar dive, kind of rebounded a little bit today. So is it on its way back? Who knows, right? This is the roller coaster we're on, and it's continuing into 2022. So again, a lot of people, in one of the reasons why there is this roller coaster is the number of people that are involved, right? It's something happens and everybody jumps on the bandwagon, and the price fluctuates because of that. But what that also did was cause a lot of people to have these tax issues when they're buying and selling crypto and they don't really understand the tax implications of crypto. This is today's tax talk. Again, even though it's Crypto Tuesday, talk about the tax aspects of that. So there's two good articles today, and they seem from the same source. So we're gonna talk about them. The first article is Made a Killing with Crypto in 2021. how to calculate your tax bill. Now, again, they don't really tell you how to, they just give you the issues. After a record-breaking year for cryptocurrency in 2021, many investors may soon face a hefty tax bill for their good fortune. But it can be difficult to calculate digital asset balances without Form 1099-B summarizing profits and losses. And even with the 1099-B, if you're moving assets around from Coinbase into your wallet, into another exchange, and so on, it gets very complicated on trying to track what your basis, what you bought it for, and then to calculate the profit. What is the difference between what I sold it for and what I paid for it, or the loss, right? And remember, it still has not passed that the lost sale rule is still in effect. Will they change that and make it retroactive? The answer is probably, but I don't know. We don't know. We'll see. After a record-breaking year for cryptocurrency, many investors may soon face a hefty tax bill. The digital asset market value soared past $2 trillion, with Bitcoin reaching an all-time high of 69,000. I think it was under 40,000 for the first time all year, just in the last week. Reaching a high of 69,000 in November, and Ether surging to nearly 5,000 during the same period. While prices dipped in December, many investors still saw sizable year-over-year growth. Here's a look at more tax planning. Be prepared to pay some taxes. Well, whenever I buy something and it goes up, generally I'm going to pay taxes. But here's the thing, right? It's generally with crypto, it's you talk about capital gains. Well, I only realize capital gains when I sell the asset. And my capital gains rate is going to change depending on how long I held the asset. There's short-term capital gains and long-term capital gains. So this all comes into play also. And you have to always keep that in mind. A lot of people are using crypto for an exchange of value, or rather than a storage of value. And then there's probably a taxable event each and every time you use it. I buy something, it's kind of like a sale. I sold it. So then whatever the value of that I bought is what I sold it for, according to the IRS. I just thought I'd put that in there. But calculating your balance can be tricky, he said, particularly if it was a year of heavy trading. The heavier the trading, the harder it is, right? Because it's hard to track it all. I have a client that gave me Excel spreadsheets, page after page of his trades, and the IRS says he owes over $450,000. He says he didn't make any money, and actually I looked at he didn't make any money, but the IRS says he made money. And so going through these records and to determine the basis of the trades and how that all works is quite a challenge. So here's the Bitcoin prices. Look, it's been down a lot this last month. Crypto taxes. Since cryptocurrency is considered property, and we talk a lot about that on this show, right, that it's property and it's not a stock or a bond, it may be subject to capital gains when exchanged or sold at a profit. If you exchange digital coins, cash out to U.S. dollars, or make a purchase, it may be a taxable event. And the gain and loss is the difference between your purchase price, known as the basis, and the value upon sale or exchange, and tax rates depending on how long you have owned the coin. Hey, I think I just said all that. Didn't I just say all that? I'm not going to go through these charts about what's the rates of what's taxable, because that gets too complicated. Be happy to review it with you, but it doesn't go well on a podcast and on the screen here. So you may qualify for long-term capital gains rates of 0, 15, or 20%, depending on your taxable income if you hold the currency for more than 1 year. However, selling or exchanging assets after less than 1 year triggers short-term capital gains with regular income tax rates up to 37% for top earners. And again, oftentimes the tax burden makes the difference whether you should buy it or sell it. Right? If I sell something at a profit, but I'm not going to realize the profit, why would I sell it? I should probably hold on to it, and not even unless, again, the lost sale rule, and that gets complicated. And many crypto investors trade digital coins frequently, with roughly 1/3 trading weekly or monthly, and nearly a quarter trading every day. Again, another chart Not going to go into that. Another chart. Not going to get into that. One of the biggest crypto tax challenges many investors don't keep records of transactions. Critical to keep these records. Critical. Because as I mentioned, if you're moving them from one exchange to another, putting them in your wallet and take them out of the exchange, no one entity can give you all of that information because there's different entities. So Coinbase won't know what's going on in a different exchange, and the different exchange won't know what's going on with Coinbase. So they won't be able to tell me the basis. So they can't give me proper records, and I'll have to put that all together myself. And so it makes sense to keep records as you trade. This is the one I'm selling. This is what I bought it for. One of the biggest investors don't keep records of transactions. It's difficult for exchanges to track assets moving between wallets. I thought I just said that too. For example, if you bought Bitcoin, I'm not going to give you because I just gave you that example. While the deadline for Form 1099-B, which brokers use to report an investor's profit and losses, is due by January 31st, it's unclear which crypto exchanges, if any, will send these forms by 2021. I believe they're all going to be required in 2022. Despite limited reporting, the IRS still expects you to report crypto transactions. No kidding. If exchanges don't provide Form 1099-B, you may be left with each broker's spreadsheet of transactions and other reporting options, which may be difficult to reconcile. They are. Let me attest to that. They are difficult to reconcile. The best thing is to try to reverse engineer it. You can reconstruct records by importing each exchange's files into crypto tax reporting software. It is overwhelming when it's a big mess, but everything adds up eventually. Yeah, if you do the job, if you do the reconciliation, there are several companies that can provide to summarize crypto activity and file your returns. However, errors may be possible and the reporting may not be sufficient for IRS audit. Always be careful of that IRS audit. So that also led me on the bottom. They had a link to this story. Make a killing on NFTs and crypto. The IRS may tax them differently. And so I'm just going to highlight this because I think it's important with the difference between NFTs. Non-fungible tokens are likely considered collectibles, which carry a 28% top federal tax rate on long-term capital gains, according to tax experts. That's higher than the 20% top rate that applies to investment returns for stocks, bonds, and cryptocurrencies like Bitcoin. However, the IRS hasn't explicitly said that NFTs are collectibles. Whatever's best for the IRS is what they're going to hold. I can tell you that. In the digital realm, all taxes aren't necessarily equal. Amid a cryptocurrency and non-fungible token boom, wealthy owners may pay a different tax rate on investment growth in such holdings. And specifically, an investor who sells an NFT, such as a digital art, may owe a top 31.8% federal tax rate on any earnings. By comparison, appreciation in Bitcoin, Ethereum, and other digital coins is subject to 23.8% top rate. That's because NFTs are likely collectibles for tax purposes. Collectibles carry a higher maximum tax rate on capital gains relative to assets like stocks, bonds, and cryptocurrencies. The IRS hasn't explicitly said that NFTs are collectibles, leaving some room for interpretation. But many tax experts believe that they clearly belong in that same group as art, antiques, gems, metals, stamps, and coins, which the IRS has labeled as tangible collectibles, subject to a higher tax rate. I don't see how it's not a collectible. Well, as I mentioned, I think the IRS is going to find that they are collectibles. NFTs are essentially one-of-a-kind digital assets which can extend beyond art to things like tweets and GIFs. The NFT market has grown quickly. Sales hit $6 billion early, up from $22 million the year before. In March, Christie's became the first major auction house to sell an NFT-based virtual artwork. The piece sold for $69 million. The number of NFT buyers are also swelled. Similarly, crypto craze has gripped investors of late. More than 10% of American adults own cryptocurrency, which almost two-thirds buying it over the past year. So as I mentioned, a lot of people, new people buying. They don't really understand the tax implications. I don't know if they understand what cryptocurrency is actually. Everybody hears everybody making millions of dollars, and so they jump in. By the time everybody jumps in, it's usually too late. Investors pay capital gains tax. This is what I wanted to get to. When they sell an asset, the levy is owed on any appreciation that occurred since purchase. The IRS generally taxes long-term capital gains at a top 20% federal rate. Long-term gains apply to crypto and other assets owned for more than a year. In 2021, a single person with taxable income of more than $445,000 paid the 20% top rate. Less affluent individuals pay a 0 or 15% capital gain rate, depending on income. Wealthier individuals owe a 3.8% surge tax on investment income, which kicks in at a more than $200,000 of income for singles and a total of 23.8% federal tax on capital gains. However, collectibles, which tend to be owned by super wealthy, are subject to a different tax regime. Their long-term capital gains are taxed at a higher top federal rate of 28% and kick in at different income levels. The 3.8% surtax also applies. So wealthy NFT owner could owe up to 31.8% in federal taxes on the appreciation. If you have artwork or a classic car, for example, you're likely a super high net worth individual, which is why the IRS has the special long-term capital gains rate. Confusingly, different income thresholds apply to capital gains taxes for collectibles. Investors pay ordinary income tax rates on collectibles appreciation up to maximum 28%. If your ordinary rates are below 28%, you pay your ordinary rates. But if they're above 28%, you just pay that rate. Conversely, someone at 37, as I mentioned, though prevailing throughout among tax practitioners seems to be that NFTs are collectibles, the matter isn't necessarily closed. The IRS lists art and other tangible personal property as a collectible. NFTs likely fall under the art category, placing them in the collectible category. But NFTs are also intangible, placing them in a murky area of tax law. Is it a collectible? It's not well settled yet because it's hard. It's still a brand new area. Non-fungible tokens. Okay, so they're not fungible, taxable. Okay, so that's where we are with that. I think it was an interesting read, just to give you some perspective and an introduction to how this might be complicated or work. If you're having tax problems, if you have these issues or questions, feel free to give us a call at Open Tax Advocates. That's what we help people do, right? We help people in tax planning, fighting the IRS, structuring your business, things like that. So you should give us a call, 312-664-6649. Again, it's 312-664-6649. As I close every show, I tell people, if you're facing IRS problems, you want to know, what's the first thing you do? How do I go about this? How do I solve this problem? It's because usually these tax problems linger a long time. Here's the first thing you do. Get a copy of my book, Deal with Your IRS Problems Today. Go to freeirsbook.com, freeirsbook.com. Get yourself a copy. Be happy to send it to you. So thanks so much for joining us here for Crypto Tuesday. We'll be back tomorrow with another edition of today's Tax Talk. And I hope you join us. Won't you?